Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So the topic of today's video is a very important one, and it's basically, are you fit to own stocks? Are you the type of person where investing in the stock market is something that is going to work very well for you, and you're going to be able to handle the volatility of the stock market and all the things that come along with it in order to get that, what's historically been a superior return to other asset classes. So we often hear this idea that the stock market has outperformed all other asset groups over the long term. It's produced 7 to 10% a year, somewhere in that range. But to actually get to that 7 to 10% a year number, it can be a very wild ride, as we're kind of seeing at the moment. So I want to talk through some fundamentals of, what it takes to own stocks and actually achieve that type of return. Obviously, nothing's guaranteed in the stock market. Past performance is not indicative of future performance, all those sorts of things. And I'm no professional financial advisor or anything like that. I'm just an everyday guy who likes to talk about investing. So I hope you enjoyed the video. Let's get into it. First, I'm going to start us off with a Warren Buffett clip, which is going to set the scene and be very useful for us. So here we go.
What are they missing?
Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because a stock goes down, you shouldn't own a stock at all. No, I mean,
what are dumb things? Selling a stock because it goes down?
selling a stock because it goes down. I mean, if you buy your house at $20,000 and somebody comes along next day and says, I'll pay you 15, you don't sell it because the quote's 15. You look at the house or whatever it may be. But some people are not actually emotionally or psychologically fit to own stocks. But I think more of them would be if you get educated on what you're really buying, which is part of a business.
You have it from Warren himself, the greatest investor of all time. Some people are simply just not fit to own stocks. So I want to dive into that, and I also want to put up some stats of, like I just said earlier, a lot of people go out and we hear this idea of getting that 7 to 10% return in stocks. But I'm going to put up a chart here that shows the actual return of the average investor in the stock market. And it is just ridiculous how much lower it is than that 7 to 10% figure. And personally, I think a lot of that has to do with something Warren Buffett was just talking about around how people are far too emotional when it comes to stock market investing, and how a lot of people aren't that fit to own shares, own stocks generally. So basically, long story short, if you just want to get the point of this video right from the start, it's you shouldn't do dumb things when a stock goes down. You shouldn't sell it because it was cheaper than it was yesterday, and vice versa. You shouldn't buy it just because the price is going up. Unfortunately, there's a lot of people out there that are first getting into investing and they're not necessarily educated on exactly what they're buying, and they think of shares and businesses as these things that kind of fluctuate and move around a little bit. They kind of go up over the long term, and you just look at a price chart, and if it's going up, then that must be a good investment, and if it's going down, it must have been a bad investment. And that's really not the way to think about investing in the stock market. What you're buying at the end of the day is a piece of ownership in a business, and that's exactly how you should treat it when you go ahead and make a purchase or sale decision. You say, if I was buying this entire business as a private owner, would I be willing to pay this price, the price that the business is currently trading for publicly in the stock market? And once I own that business, if I bought it for $100,000 and someone came to me the next day and offered me $80,000 because that's what they thought it was worth, would I go ahead and sell that business? And the obvious answer generally is going to be no. But unfortunately, that's not the mindset that a lot of people have. A lot of people are out there trying to time markets, trying to, buy at really high prices and hope that someone pays even more for that business down the track. And we're seeing a lot of people get caught out, especially right now. There's a lot of panicked investors, very new investors, who are falling into the trap of selling just because prices are going down. And that is basically the exact opposite of what you want to do. So we know that the best thing you can possibly do when you're investing in stocks is to think about it like owning a business, and that makes a whole lot of sense. And that's a mental model that has kind of helped me stay rational through volatile times and not get carried away when prices are exploding on certain stocks and kind of being pulled into that hype and into that kind of mania of price action. So that's the way I really like to think about these things. Unfortunately, it's the nature of not just stock markets but asset prices generally, is that when prices are going up, a lot of people get attracted to that, and when prices are going down, a lot of people get kind of pushed away from that. And that's probably one of the main reasons why individual investor returns have been so low. When you see other particular investors that are following this kind of value strategy and buying below intrinsic value, selling above intrinsic value, and those sorts of things, have done so well over time, is that they're able to think in basically the exact opposite way to how the average investor thinks. And the average investor tends to think like this: they see prices going up, they see their neighbor making a bunch of money, they see their friend on Facebook making a bunch of money, and it's kind of a self-fulfilling prophecy that as prices go up, it attracts more people, which makes the price go up, which attracts more people. And this is how bubbles are formed. This is what we saw in sort of the Bitcoin bubble of 2018. It's what we saw in the tech bubble in 2000. It's what we saw in the housing market bubble in the States in 2007. It's what we saw in the tulip bubble a couple of centuries ago. All of these massive price changes can attract a lot of money very quickly, and it can just simply push prices to irrational levels. Now, we have the example of the Japanese Imperial Palace, which I'll put up a photo of the Imperial Palace here. And if you're not familiar with the story, this was basically the bubble to end all bubbles. Unfortunately, it hasn't ended all bubbles, but it's the biggest bubble that I think I have ever seen personally. And basically the Imperial Palace, like I say, I'll put up a picture of it here so you can see what this thing actually looks like if you're not familiar with it. In the peak of the real estate bubble in Japan, this palace was valued at the exact same amount of all of the real estate in the entire state of California. Now, if you know anything about the sheer size of California, firstly, plus all the seaside real estate and all this really high-end real estate that California has, it's pretty unbelievable to see that an asset like that in Japan can be valued at more than the entire real estate in the whole state of California. It's just ridiculous. And when you buy something at a price like that, you're probably talking centuries before you start to make any sort of return. So price is very important. Staying rational with the price that you pay is very important, and being able to stay the course is equally important. The stock market, an auction-driven market, has always been a wild ride. Simply looking at a chart of annual returns and something like the S&P 500 will show you that very clearly. And although you will probably get somewhere in that 7 to 10% return range over a long period of time, you're not going to achieve that every single year like clockwork. That's basically the complete opposite of what will happen. So you have to have the ability to stay the course in this kind of asset class. If you don't have that ability, the stock market, unfortunately, is probably not for you. It may be for you if you're able to just completely ignore things and not even look at what your investments are doing for a decade or more. Might be a strategy as well. So you've got to be able to stay the course. If we just look at even the past 20 years or so, we've already seen a number of significant corrections. The tech bubble being the big one, we saw something like 40% drawdown off the top of my head, much more for technology stocks, and a lot of value stocks actually even went up through that period. So it was a very unusual time. We saw the 2007-2008 financial crisis turned out to be a wash of opportunities for the next decade, but we saw some massive crashes in particularly the housing market, but it also flowed through to the stock market and banks and all those sorts of things, which I'm sure you already know. And we may well be in the middle of another drawdown now. So we're down 20 to 30%, again, depending on what index you look at. due to the virus that I cannot name without getting demonetized on YouTube. So you have to be able to stay the course. You have to recognize that when prices are low, they are often buying opportunities. Don't take that as an action of financial advice or anything like that. But, historically speaking, pretty much every time that prices have got dramatically lower very fast, it has been a great buying opportunity. And pretty much every time that prices have got dramatically higher very fast, it has been an opportunity to step back a little bit, be a bit more wary with where you're putting your money through those periods of time, and just kind of being cautious, because if you pay a huge premium for a business and that business doesn't grow into that valuation, you're probably looking at quite poor returns, unfortunately. So those are a few things to look at. Some people are simply not fit to own stocks. My top tips, if you do want to get into stock market investing, or if you're already an investor, is to think of buying shares like buying a piece of ownership in a business. As simple as it sounds, that mindset change will dramatically improve your results if you can buy businesses at appropriate prices and just hold on to them. That's basically all there is to it. So don't overpay for a business. Know what they're worth. Know the intrinsic value, and stay the course once you do own it. Take the advantage of very high prices as a selling opportunity if you've got other places to put the money. Take advantage of low prices, as a buying opportunity for a business-minded person. And all of these things can add up to compounding your results a lot quicker than the average investor, and potentially even a lot quicker than the market as well. So those are some top tips for me. I do hope you enjoyed the video. If you did, hit like, hit subscribe. You can watch some older videos over there. Hit subscribe over there, and I will see you in the next one. Cheers.